Stands for Advanced Audit and Assurance. Advanced Audit and Assurance. There are two papers in ACC about auditing. One is compulsory that we have studied at skill level audit and assurance doubling. Now we are moving towards advanced audit and assurance. Extension to that paper. If you want to become expert auditor, this paper will help you to become auditor. I mean, you can choose auditing field after studying this paper. Even after studying this paper, if you have qualified ACCA, you can open your own auditing firm and you can register your firm under ACCA. So let's discuss what is this paper. Advanced Audit and Assurance. Let's start with the definition of audit. What is audit? Independent examination of financial statement. Ragi, what is audit?
Audit is the process to verify a company's account, which that is accurate or not. And
okay, so you got some idea what is audit. So let's define properly what is audit. Audit means to express an opinion. Audit means to express an opinion. Independent examination of financial statements, that is fine. But from auditor point of view, what is audit? To express on an opinion. On what? On financial statement of the company. What kind of opinion? We need to give opinion whether financial statements give true and fair view or not. Audit means to express an opinion whether financial statements give true and fair view or not. Who prepare financial statements? Company management directors. It is the responsibility of company management, company directors. They need to prepare financial statements for whom? For shareholder. They can show their accountability towards shareholder while showing them financial statements. These are the income, these are the expenses, this is the profit. That's why we are paying this dividend. And this is the financial position of your company. These are the cash flow. These are the changes in equity. How shareholder rely on financial statement? Because these are prepared by directors. It could contain some fraudulent transactions. It could contain some errors. So shareholder appoint auditors. Who appoint auditors? Shareholder. Why? To give opinion on the financial statements. Please check these financial statements prepared by the directors and give us opinion, mean a report where you will say whether financial statements give true and fair view or do not give true and fair view. If we are saying financial statements give true and fair view, this provide relaxation, confidence to the shareholder. Yes, financial statements are true and fair. This means directors, management managing their business properly. If we are saying financial statements do not give true and fair view, if we are saying financial statements do not give true and fair view, this means the management is trying to deceive the shareholder. Then they need to make some decision. Either they need to change the management, either they need to withdraw their investment. Mean our audit report help the shareholder in making their investment decision in the company. So audit means to express an opinion on financial statements, whether they give true and fair view or not, and are prepared according to a framework. A framework means accounting standards. What are accounting standards? IAS, IFRS. In our opinion, we need to provide two kind of opinion, whether financial statements give true and fair view And second, we need to see whether they are prepared, mean financial statements are prepared as per accounting standard or not, accounting standard that are applicable for the company. It could be different than IAS, IFRS according to the legal jurisdiction. In some countries like UK, companies need to prepare financial statements as per UK GAAP rather than IAS, IFRS. In India, some years back, they need to prepare financial statements as per Companies Ordinance 1984 rather than IAS, IFRS. Still, in some areas, they are preparing according to Companies Ordinance. But now, mostly around the world, companies are preparing financial statements as per IAS, IFRS. So, who conduct audit? Auditors. Where they come from? Audit firm. They are independent. They are having no connection with the company. They are having no connection with the shareholder. They are independent people coming from the audit firm to whom shareholder has appointed, shareholder has assigned a task. Please check these financial statements prepared by my directors and give me opinion whether the financial statements are true and fair or not. So we got some idea what is audit. Being auditor, audit is not independent examination of financial statements. Audit means to express an opinion to shareholder in an audit report, mean one-page audit report, whether financial statements give true and fair view or not and are prepared according to accounting standard. Or we can expand this definition further. Audit means to express an opinion whether financial statements are free from material misstatement or not, and are prepared according to accounting standard. Means saying financial statements give true and fair view, or saying financial statements are free from material misstatement having the same meaning. So second definition, audit means to express an opinion whether financial statements are free from material misstatement or not and are prepared according to accounting standard. Or there is an alternative term used. Audit means to express an opinion whether financial statements prepared in all material respects or not. Financial statements prepared in all material respects mean there is no material misstatement, mean they give true and fair. So these three terms alternatively used having the same meaning, mean financial statements give true and fair view, mean there is no fraud and error, they are okay. Financial statements are free from material misstatement, mean there is no big misstatement, they are okay. Financial statements are prepared in all material respects, mean there is no material misstatement, they are okay. Who express this opinion? Auditors. Where they come from? Audit firm. So to pass this paper, we should think like an auditor from today onward. We need to realize ourselves we are the auditor. And being an auditor, we need to answer different requirements of the examiner in this paper, then we'll be able to pass this paper easily. If we are not becoming auditor from today onward until our exam, it will be difficult to pass this paper. So suppose we are auditor. We are having audit firm. Our firm name is ABC Auditors. What we do? We conduct audit of different companies' financial statements. So we are the auditor. We are having our audit firm ABC, one of the client approaching us and requesting us, please, can you conduct audit for my company financial statement? What we should do? If any of the client approaching us and requesting to conduct audit of its company financial statements, what we should do? We should say him thanks. Oh, thank you so much. You are coming to us. You are going to become our source of income. Let's play audit. No. We should not accept the audit blindly. We should not accept the audit blindly. Before accepting audit, we should check few things. We should confirm different points. We must ask a little bit questions from the client. Based on the positive answer of those questions, we should accept the audit and continue. Otherwise, we should try to avoid conducting the audit. Have you heard about the Enron case? Enron. What was Enron case? Enron scandal. It's the biggest scandal in accounting and auditing industry. What was that? Enron was energy-based company in USA. A big corporate having thousands of employees. Not only this company was operating in USA, they were having some connection, means some joint venture, subsidiary, associates in other countries around the world as well. I mean, this was a big corporate giant having thousands of employees, having different offices all over the world. And their auditor was Arthur Andersen. Nowadays, there are big four: Deloitte, PwC, KPMG, EY. 22 years back, there were big five firms around the world. The fifth firm was Arthur Andersen, who was auditor of Enron. What happened? In 2002, this Enron company management committed a fraud while preparing financial statements. What they did? They omit $7 billion liability from the financial statements. $7 billion liability they omitted while preparing the financial statements. Why? So that they can show strong financial position of the company. By showing strong financial position, they can attract more investors. And through attraction of more investors, they could rise up the company share price, and the shares the management have bought by themselves before issuing the financial statements. So that after having a high share price, they could be able to sell shares at high price. Their auditor was Arthur Andersen. They were known $7 billion liability is omitted from the financial statements, but they expressed financial statements give to and fair view. Mean they were also involved in fraud. In fact, Arthur Andersen was not only providing auditing, they were providing accountancy, taxation services to Enron as well. Mean they themselves are involved in preparing the financial statements as well. What happened as company published their financial results? Investors saw, wow, what are results? They started investing into the company. There was huge demand of company shares. Bank realized this company have bought asset on a lease basis from us. How could they are having that much strong financial position? They compare current financial statements with previous year, and they realize asset increase is in the financial statements, but liability, lease liability increase is not shown there. Bank disclosed the facts. Suddenly, it became public headlines. Shareholder tried to withdraw their investment. There was a sale supply of share, but there was no demand. So company share price dropped down to $1. Company became bankrupt. Investigation found that Arthur Andersen were also involved in the fraud. Arthur Andersen licenses cancelled all over the world. They are unable to operate as an auditor. And since then, we are having big four, this big five, I mean fifth firm eliminated, collapses all over the world. Just one wrong report have destroyed the complete firm around the world. Obviously, the auditors who were working in Arthur Andersen, they lost their job. They tried to move towards other firms, and there was a big disturbance in audit industry as well. So that's why we should not accept the audit blindly. If we are seeing financial statements give true and fair view, while in fact financial statements are not true and fair, and afterward it was found we were guilty in checking the financial statements, we haven't performed procedure properly, mean our opinion becoming wrong due to negligent work. So we'll be paying damages to the shareholder, we'll be paying damages to the investors who made investment decision based on our audit report. One wrong report would destroy our whole life like Arthur Andersen. Suppose one of the client has approaches us, please, can you conduct audit of our company financial statements? We should not accept the audit blindly. Before accepting the audit, we should check, we should verify a few points. What we need to check? We need to see this company is coming to us today. What's the date today? What's the date today? 28th of December 2024. We should ask the client, what's your company year end? Suppose they are saying our company year end is 31st March 2025. So their year end is 31st March 2025. What we are checking? What is their year end? This means today is December. This means before year end, we are having January, February, March, 3 months. Normally, we express opinion after 3 months of the year end, after 90 days of the year end. We will express opinion on what date? 1st of July 2025. We haven't accepted the audit yet. But we are checking whether we are having enough time to conduct the audit. Because due to shortage of time, we will not be able to verify account balances properly. And if we are unable to verify account balances properly, we will not be able to express appropriate opinion. Our opinion could go wrong. So we haven't accepted the audit, but we are checking whether we are having enough time to conduct the audit or not. So yes, we are having about 3 months before the year end and about 3 months that is necessary after the year end we are having. The time or the audit work we perform before the year end has finished is called interim audit. And the audit work performed after the year end has finished is called final audit. So yes, we are having 3 months for interim audit. We are having 3 months for final audit. I mean, we are having 6 months. So in 6 months, we can verify things properly in detail. There is no issue of time. So we haven't accepted the audit, but we are checking whether we are having enough time to conduct the audit or not. So time is not issue. Not only time, we need to see whether we are having a staff available to conduct audit of this client as well. Suppose we are having other clients as well, and their year end is also 31st March. This means our all staff will be engaged with whom? Other clients. So who will conduct audit for this company? Because if there will be shortage of staff, so due to shortage of staff, we will not be able to verify things properly. Our opinion could go wrong. So we checked our other clients, some are having year end June, some are having December. So we are having staff available. There is no issue of staff. We haven't accepted the audit yet, but we are checking whether we are having enough time to conduct the audit or not, whether we are having enough staff to conduct the audit or not. Okay, we are having staff, but in staff, we need to see whether our staff have conducted this kind of company audit before or not. I mean, they are having experience, skills, I mean, knowledge of conducting audit of this kind of company or not. Because if the business nature is different and we haven't conducted audit of this kind of company in past, so we'll not be able to verify things properly because we'll not be able to understand the system. So we need to see whether our staff is having skills, experience, and knowledge of the business. If these things are appropriate, we should accept the audit. Otherwise, we should check the audit. We should not accept the audit. Because due to time shortage, due to staff shortage, due to inexperience, due to not having knowledge of the business, our opinion could go wrong. So we haven't accepted the audit. But we are checking, we are having enough time, we are having staff, our staff is having experience, skill, knowledge. If there is no skill, experience, knowledge, either we can train our staff, either we can recruit skilled staff or not, we can check these things as well. In fact, we have started a topic called procedure before accepting audit. Before accepting audit of any client, we should perform some procedures. Before accepting the audit, first we should check our qualification. Who will conduct audit? Auditor. The word auditor means member of any recognized supervisory body like ACCA, ICW, ICAI. And how to become that member? We need to pass 13 paper of ACCA. We need to complete 3 years PER. Then we'll be able to become members. Without a member, we'll not be able to sign the audit report. So before accepting the audit, we should check our qualification. Qualification from legally point of view. Legally mean whether we are member of any body. In India, ACCA member cannot sign the audit report. In UK, Chartered Accountant of India cannot sign the audit report. Only ACCA member, ICW member can sign the audit report. So we need to see whether we are legally qualified auditor or not. Legally, if you are the shareholder or employee of any company, you cannot become auditor. It is legally disqualified. So we need to see whether legally we are qualified. Not only legally, we need to check our ethical qualification as well. Ethically, if there is any threats on our independence, we are ethically not qualified auditor. We should not conduct the audit. Otherwise, it could compromise our work. It could influence our opinion. So before accepting audit, we should check our qualification. Legally, ethically point of view, we should check adequacy of resources. Mean whether we are having adequate, mean enough resources to conduct the audit or not. What are the resources we need to check? Whether we are having enough time or not. We are having enough staff or not. Our staff is having skill, knowledge, experience of client company, as well as we need to check the other things like if the client system is computerized, whether we are having audit software to conduct the computerized audit or not. Because if the client system is computerized, we can conduct audit by using audit software. If we don't have audit software, this means we don't have resources to conduct the audit. We should not accept the audit. Before accepting the audit, we should check integrity of client management. Integrity of client. What is meant by integrity? Honesty. Whether the management of client company is honest. Mean we should check their repute, their past repute. If they were involved in any kind of fraudulent activities in the past, this means they are not honest people. We should not associate ourselves with dishonest people, with the wrong people, because there could be chances of fraudulent activities in the financial statements. If we are unable to identify, our opinion could go wrong. Before accepting the audit, we should check what? Limitation in scope of work. We should check whether there is any limitation in our scope of work or not. Scope of work means whether the records are available on which we can perform procedure to verify things. If we need any information, if we need any access to the records, whether company management will provide us that access, that information, mean there shouldn't be any restriction on our work. Because if there is any restriction on our work, we should not accept the audit, because we'll not be able to verify things, we'll not be able to obtain evidence. If we will not be able to obtain evidence, we'll not be able to express the opinion. So that's why before accepting the audit, we should check whether there is any limitation in our scope of work or not. Before accepting the audit, we should check future viability of our client. The future viability. Future viability means going concern of the client. Whether the company to whom we are going to conduct audit, they are going concern or not. If company is not going concern, this means within 2-3 months, company will collapse, company will end their business. Our whole work will lost, will not be able to recover even our fee. So we should not conduct audit, we should not accept audit of a company who is not a going concern. If there is any other opportunity of going concern company, we should accept that, because that we can continue for so many years. That will be our permanent client. If a company is not going concern, there are always high chances of misstatement in the financial statement. Because company management try to manipulate the results for recovery of any money, for any survival, either through bank support, either through shareholder support. They always try to manipulate the results. I mean, there are always high chances of fraud in the financial statements. That is a separate thing. We can conduct audit of one company throughout his life. For 100 years, even we can conduct an audit of one company. We don't need to change the firm. We don't need to change the firm. We need to change the auditors, not the firm. Firm will remain same. There is no restriction of that one company can, one firm can conduct audit for this year. No, one audit firm can conduct audit for so many years as they wish. So before accepting the audit, we should check our qualification. We should check adequacy of resources. We should check integrity of client management. We should check scope limitation. We should check future viability of client. Before accepting the audit, we should check, or we should obtain professional clearance. What is this professional clearance? We should see why the previous auditor is not going to continue audit. Why company is changing auditor? Asking a previous auditor, contacting previous auditor and asking a reason behind leaving the audit is called obtaining professional clearance. Because that reason could restrict our work in future as well. So before accepting audit, we should contact and ask the reason behind not continuing the audit from current auditor to whom we are replacing. This is called obtaining professional clearance. And to obtain this professional clearance, we need permission from our client. Even that auditor need permission from the client to answer our query. If client is not permitting us or to other auditor, this means there is any issue. We should not conduct the audit. We should not accept the audit. Before accepting the audit, we should obtain client identity. Client identity means we should check whether this company is a registered company. We should check this company is performing any legal transactions. They are not involved in any kind of illegal transaction like money laundering. We should check identity of their main representative, like their directors, their chairman, CEO. We should check about their repute in the industry as well. They are legal person, they are not wanted person, they were not involved in any kind of fraudulent activities in the past. Mean we should obtain client identity, mean we should obtain, we should perform client screening. Client screening means checking registration of the company, checking the legality of company transaction, checking the legality of a main representative of the company. We can obtain some information through industry as well, through our other clients who are having connection with them. Because if there is any issue, like the main representative were involved in any kind of fraudulent activities, this means there could be chances of fraud in this company as well. Companies performing illegal transaction like money laundering. If we are becoming auditor of this company, our association with these wrong people could affect our reputation as well. So we should avoid having association with the wrong people. So we haven't accepted the audit. If these procedures providing us any positive answers, we should accept the audit. Otherwise, we should say goodbye to the client. Oh, thank you so much. You approached us, but we are unable to perform your audit. Not say this is your issue. No, we are unable to perform audit this time, please. Because if there is problem in any of the point, ultimately our opinion could go wrong. It could affect our audit work. Our opinion could go wrong, and giving one wrong opinion could destroy our whole life, could destroy our whole professional career, like Arthur Anderson. So suppose all these procedures giving us positive answer, and we have accepted the audit. Now, if we have accepted the audit, so let's see how we will conduct the audit. I mean, how the audit is performed. We are going to discuss an audit process. I mean, how auditor start the work, what auditor do during the audit, and how finally he reach towards expressing the opinion. So we are going to discuss audit process. In audit process, the first thing before starting the audit work, what we do, we plan our audit. Plan mean we highlight risky areas in the financial statements, the areas where there are more chances of misstatement, so that we can give a list of risky area to our audit team where they need to perform detailed work, mean more work. We compare current year financial statements to the previous year. If there is any change in any of the account balance and that change is too big, is not justifiable, so we highlight as a risky area, mean this area we need to check, we need to verify in more detail during the audit. If there is not much change in any of the account balance, this means this is low risky area. We don't need to spend too much time during audit on this area, just a little bit of verification is enough. So we'll perform planning. Planning mean we will highlight risky areas. Risky areas mean areas where there are more chances of misstatement, so that we can assign these areas to our audit team where they need to perform detailed work. After that, what we need to do, we need to ascertain mean obtaining knowledge about accounting system and internal control system of our client. What is internal control system? What is mean by internal control system? Internal control system mean policies, procedures that work in the company, that everybody follows in the company. This is called internal control system in policies, procedures. So we'll take knowledge about accounting system of the company, mean what is their accounting system, how they prepare financial statements, whether they prepare journal, whether they prepare ledger, they prepare that by themselves, whether they have outsourced, they are preparing manually, they are preparing computerized. The staff they have employed in accounting department, in accounting staff, whether they are having qualified staff, mean ACCA qualified, chartered accountants, or BCommer. So we will take knowledge about the accounting system of the company as well as internal control system, whether they are having policies, procedures or not. How we can obtain this knowledge? By inquiry from client staff. How you record the transaction, how you record inventory, how you manage inventory, how you manage your asset, how you record working hours of the labor, whether you perform any checks on the working hours performed by the labor. So we'll ask questions. Through inquiry, we can obtain a knowledge about the accounting system and internal control system. Or every company is having a register of their policies, procedures. So we can take knowledge about internal control system from company files, folders, the registers as well. And in file folders, the policies are written very beautifully. But in fact, they do not work accordingly. So after obtaining knowledge of the accounting system, internal control system from the files, folder registers, as well as client staff, what we will do, we'll perform a walkthrough test. Walkthrough test means for each area, the knowledge that we have obtained about the policy procedures, we will verify whether those policy procedures are working or not. We will test 1-2 transaction of inventory to see whether those policies are working or not. We will test 1-2 transaction of wages, whether those policies are performing or not. We will test 1-2 transaction of asset sale, purchase, whether the policies, procedure that we have read, we got knowledge from the client staff, whether they are working as per that knowledge or not. If they are working as per that knowledge, through this we'll be able to evaluate the internal control system. If they are working as per the knowledge, this means client control system is what? Strong. But if while performing walkthrough test, we realize that system do not work as per recorded in the files folders, this means client control system is what? Weak. So how we should start audit? First, we should plan our audit, mean highlight risky areas while comparing the financial statements, so that we can prepare a list of high risky areas that we convey to the audit team, where they need to perform more work, where they need to verify things in more detail. Then we will obtain a knowledge about the accounting system, internal control system of the client. And to test that knowledge that we have gained, mean to evaluate those knowledge, we'll perform walkthrough test. Walkthrough test means we will check 1-2 transaction of each area, not more than this. Means sample size should be very small. And through this, we'll be able to evaluate the internal control system. Either the control system is strong, mean work as per recorded, or weak, mean do not work as per recorded. If the control system is strong, this means policies, procedures are working properly. There is no chance of fraud and errors. Being auditor, our life is simple. We don't need to perform more work. We don't need to perform detailed work. But if we realize control system is weak, this means policies, procedures are not being performed properly. There are more chances of fraud and errors. If there are more fraud and errors, this means being auditor, our life is tough, because we need to identify those fraud and errors. How we can identify those fraud and errors? We need to perform more work. We need to perform detailed work. That detailed work we need to perform is called what? Substantive procedure, substantive test mean detailed work. So through walkthrough test, if we evaluated the control system is weak, this means there are chances of fraud and errors that we need to detect, that we need to identify. How we can detect those fraud and errors? By performing more work, testing all transactions in detail. We should perform procedure on bigger sample size, large sample size, so that we can identify, we can detect those fraud and errors. And that detailed work we need to perform is called what? Substantive procedure. We will perform substantive procedure. And even substantive procedure will perform in large volume. Large volume means bigger sample size. All areas of the financial statements, whether amount is small, whether amount is big, we need to perform substantive procedure. And when we have performed substantive procedure in detailed work, this means we'll be able to identify some issues, some fraud and errors. What we will do? We will communicate to the company management through letter of weaknesses. These are the issues in your system, in your financial statements. Please correct these figures in the financial statements. If they have corrected, we will say financial statements give trend fair. But despite giving them a chance, they didn't bother to correct those issues in the financial statements. We will say financial statements do not give trend fair. So first we should plan the audit in highlight risky areas in the financial statement. Then we should obtain knowledge about accounting system, internal control system. That knowledge we should test by performing walkthrough tests. Through that, we'll be able to evaluate the internal control system, whether it is strong or weak. If control system is strong, policy procedures are performed properly. There are lesser chances of fraud and errors. We will perform lesser work. That lesser work will be called test of control. But if control system is weak, there are more chances of fraud and errors that we need to identify. This means we need to identify fraud and errors. How? By performing detailed work. Detailed work is called substantive procedure. In large volume means sample size should be larger. All account balances we should perform detailed work, and after performing detailed work, we will be able to identify different issues. Those issues we should give a chance to the company management. Might be they are not aware about those issues. We should give them a chance. We should communicate those weaknesses to management through letter of weaknesses. This is also called management letter. In this letter, not only we are highlighting the weaknesses, we are providing a recommendation how they can overcome these weaknesses, how they can correct these weaknesses in the financial statements. If they have corrected, we will issue opinion in company favor. Financial statements give and failure. But despite giving them chance, they didn't bother to correct the financial statements, then we will burst. Financial statements do not give it. Then they should face the music, whatever they are facing from the shareholder. Now, if we have evaluated control system is strong, this means policies, procedures are properly followed, lesser chances of fraud and errors, we should perform lesser work. That lesser work is called test of control. Test of control means taking evidence whether controls are working properly or not. In here, we tested the control, but with a smaller sample size. In test of control, the sample size will be appropriate, mean we will test 50 to 100 transactions whether controls are working properly. And if we are satisfied with the results of test of control, this control system is strong. Substantive procedures still we need to perform. But in reduced volume mean only main account balances. Main mean the bigger amount account balances, not all. Just to take evidence, they are okay. If control system is weak, we will perform large substantive procedure, no test of control, because control system is weak. Why we need to perform test of control? If control system is weak, there is no need to test the controls. If control system is strong, we'll perform test of control with reduced substantive procedure. Reduce mean only the main account balance we will check in detail, not all. Are you with me? If we realize control system is strong, we decided, okay, go for test of control and reduce substantive procedure. We perform test of control. If we are satisfied with the result of test of control, mean control system is strong, we will move towards reduce substantive procedure. But if while performing test of control, we are unsatisfied with the result, mean we found control system is not strong, is weak, mean our evaluation becoming wrong. Why? Because here we are testing with 2-3 transactions. Here we are testing with 50 to 100 transactions. So we be able to generate much better results in test of control as compared to walkthrough test. So if through test of control results, we realize control system is not strong, there are so many issues. In that case, we should move towards large volume of substantive procedure and report the weaknesses to company management. So what we have learned here. First, we should obtain a knowledge about internal control system, accounting system. And then we should evaluate the knowledge of internal control system obtained. How? By performing walkthrough test. What is walkthrough test? These are tests to verify system work as recorded or not. If control system is weak, we will adopt substantive approach. What approach? Substantive approach. Substantive approach means performing a large volume of substantive procedure and reporting weaknesses to company management. If control system is strong, we should adopt test of control with reduced substantive. This test of control with reduced substantive approach, this is called system-based approach. What is system-based approach? Performing test of control with reduced substantive procedure. When we should adopt system-based approach? When we have evaluated control system as a strong. When we should adopt substantive approach? When we have evaluated internal control system is weak. These all work we have performed in internal audit. Before the year end has finished. After this, our final audit will start. After the year end. What we will do in final audit? We'll perform a further test of control and substantive test. Why? When you have already performed, why you're performing again? Might be those we have performed during January, February, March transaction left. So performing again, we'll be able to check the transaction that we haven't checked. Even the transaction we have checked, they will be rechecked again. And then we will review the financial statements, whatever the weaknesses we have communicated to the management, whether they have corrected or not. If they have corrected, financial statements give trend favorable. If they haven't corrected, financial statements do not give trend favorable, will trust. So this is the audit process. How we start the audit, what work, what procedures auditor performed during the audit, and how he reached towards his opinion. And what are the approaches of audit that auditor adopt? We learn two approaches, system-based approach and substantive approach. What is test of control? These are tests to take evidence about control effectiveness. What is substantive procedure? Detail work. These are procedures to verify account balance is complete, accurate, and valid. Substantive procedure is not about checking control. It's about checking the amount. If a sale is written in income statement, we'll see whether the same amount is in trial balance, whether the same amount is in a ledger, the same amount in journal entry, and for the same amount, there is a sale invoice, there is a dispatch note, there is an order from the customer as well. The same sale amount is written in cash ledger or receivable ledger as well. This is what substantive procedure detail work. In test of control, we will not verify through documents. We'll just check the controls. We'll take the evidence whether control policies are properly followed or not. Are you with me? So let's discuss few more concepts. Audit documentation. Also called working papers. Whatever the work auditor perform, they need to document. Before accepting the audit, what procedures we performed, where we got the positive answer, where we got the negative answer, how we decided we should accept the audit, we should write down. At planning stage, who performed the planning? What risky areas you have identified, how you identified those risky areas, we need to document. Which account balance you assign to which staff to check during the audit, you need to document. From where you got knowledge about accounting system, internal control system, either through inquiry, either by reading through files or folders, we need to document. You have performed walkthrough test. How many transactions you have checked, what was their result, how you evaluated control system strong or weak, we need to document. Who performed test of control? When he performed test of control, how many transactions he has checked, what was the result, we need to document. Who performs substantive procedure? When he performs substantive procedure, how many transactions he has checked, what was the result, we need to document everything. In whatever auditor is conducting, performing, acting, he need to document everything. Why? Why? Why we need to prepare working papers? This is the support to our opinion. If we are saying financial statements give it to and fair view, any of the person come and ask how you are saying financial statements give to and fair view. We can justify our opinion by showing our working paper. See, rascal, these are the procedures I have performed. These are the results. Based on these results, I have given this opinion. Now you can prove me wrong if you can. If you don't have working paper, you will not be able to justify our opinion. Not only we should prepare these working paper, we should keep in record for next 5 years. In whatever auditor perform, he need to document, he need to prepare working papers. Not only he need to prepare working paper, we should keep in our firm record for next at least 5 years. Whatever auditor is doing, he cannot conduct audit according to his wishes. As we cannot prepare financial statements according to our wishes, we need to prepare financial statements as per accounting standard IAS, IFRS. In similar way, being auditor, we can conduct audit not according to our wishes. We should conduct audit according to standards. And those standards are called ISAs, International Standard on Auditing. Before accepting audit, we should perform these procedures. These are not defined by any of the auditor. These are defined by the standards. What is the audit process? This is defined by the auditing standards. Auditor need to document all his work. Why? This is standard saying this is the requirement of standard. You need to document your audit work. The standards are saying you need to keep in record for next 5 years. Being auditor, we need to follow auditing standards. If we are following auditing standards, will not be compromising our work. We'll always moving towards providing appropriate opinion. If we are not following standards, our opinion could go wrong. And one wrong opinion could destroy your whole life, like Arthur Andersen. So what is the audit process? First, we should perform planning, mean identify risky areas. Then we should take knowledge about accounting system, internal control system. We should evaluate internal control system by performing walkthrough test. If control system is strong, we should adopt a system-based approach. If control system is weak, we should adopt substantive approach. In final audit, we should perform further test of control substantive procedure. Then we should review the financial statements as well as working papers. Then we should move towards expressing the opinion. Why we should review the working paper before expressing the opinion? We should review the working paper, the work that we planned here, whether we have performed all work completely or not. Whether we have checked all the account balances in the financial statements that is written in the working paper, then we should move towards expressing the opinion. If anything is lacking, like any work need to be complete, is not completed yet, first we should complete that work, then we'll be able to sign audit. Who conduct audit? Auditors. Where they come from? Audit firm. From audit firm, there is an audit team who is going to conduct audit of a client financial statement. In audit team, there are different nature of auditors involved. There are different types of auditors involved. Mainly, there are 4 types of auditors involved in auditing. One is called engagement partner. Other is called audit manager, also called audit supervisor. Another is called audit senior. And the fourth one is called audit junior. Also called a trainee accountant. Who is audit junior? Who has recently joined the audit firm, having no experience of the work, who don't know how to perform procedures, who don't know how to prepare financial statements, who don't know how to prepare tax return. He's in a learning phase. Could be having 1 to 6 months experience. Audit senior, who is having more experience than junior. Could be up to 2 years experience. He know how to perform procedures. He know how to prepare tax return. He know how to prepare financial statements, but he's not qualified. Still, his some paper left. Our experience is not completed yet. Audit manager supervisor, who is supervising the audit, who is assigning work to the senior junior. And whatever the work senior junior are performing, they are preparing working paper and they are submitting their working paper to the audit manager. And he is reviewing whether the work is performed properly. And he is including the work into main working paper of the client. But he is also not a qualified auditor. Might be he has completed his experience. In one paper of ACCA, he's unable to pass even in last 10 attempts. He's struggling. Or he has completed the paper, but experience still some left. Who is engagement partner? A qualified auditor. Auditor, qualified auditor, member of the body. What he do? He signed the audit report. He is having signing authority. Because other junior managers, senior, they are not qualified auditor. They cannot sign the audit report. They can perform audit work, but cannot sign the audit report. Who can sign the audit report? Auditor. The word auditor means member of any body. And this engagement partner is thus having the signing authority. This engagement partner is involved in the whole audit process where at planning stage to highlight high risky areas. And at this stage, just reviewing the working paper to see whether all work has been performed properly, all evidence has been obtained, and then he will sign the audit report. Who will perform the audit? The audit is performed by these three people. The audit is performed by the team of these three people, mean audit manager will take one senior to junior and assign them to the audit of income statement item. Audit manager will take one senior to junior and will assign them to the audit of balance sheet. Whatever the work they are performing, they will submit their working paper to manager. He will see whether they have performed work properly and then will include the working paper into main working paper, mean audit documentation of this client. At the end, who will decide what kind of opinion we should express? Manager. And then engagement partner will see whatever the manager is saying is correct or not. If it is correct, he will sign the audit report simply. These two persons, engagement partner and audit manager, they are called key audit personnel. Key mean main person in the audit team. Main person mean who can influence the audit opinion. Senior, junior cannot influence the audit opinion. Who can influence the audit opinion? Engagement partner and audit manager, they are called key audit personnel. And the planning in the audit process is a high level activity. Our whole audit is based on planning. That's why this planning must be performed by key audit personnel. Senior, junior should not be involved in the planning because it is beyond their limits. They are not having that much competence. They are not having that much experience that they can perform planning properly. So that's why our whole audit is based on planning. If your planning is proper, you will be able to conduct audit within time, within cost properly. If there are loopholes in planning, you will not be able to conduct audit on quality basis. So that's why this planning must be performed by key audit person. So we try to define what is audit, to express an opinion whether financial statements give true and fair view or not, and are prepared according to accounting standards. Who conduct the audit? Auditors. And there are 4 types of people in audit team that we have discussed. Whatever the work we perform, we should perform as per ISAs. And whatever we are performing, we should document and prepare our working paper. But we should not accept the audit blindly. We should not go for earning money only. We should focus on our career as well. One wrong report could destroy your whole life. You could be under imprisonment. You could be facing high fines, penalties. Even your body could cancel your registration as well if you were found guilty. So that's why before accepting the audit, we should perform these procedures. How audit is performed, what is the audit process that we have discussed. We have discussed the difference between interim audit, final audit. We have discussed the difference between test of control, substantive measure, what is walkthrough test. We have discussed these things. So this paper AAA is having 3 questions. Question number 1, question number 2, question number 3. All 3 questions are compulsory. There will be one case study based 50 marks question number 1. 1 to 2 pages case study will be having 4-5 requirements for 50 marks that we need to answer. And then there will be 225 marks question. There is no choice in this paper. Altogether 100 marks paper, and to pass this paper we need to score 50. But our target should be 70 or above, then we'll be able to score 50. If we are setting our target at 50, we'll easily fail this paper in 30s. It's a little bit technical paper to pass. 100 marks paper mean you need to write down 100 lines, 100 points in the exam paper. If there is any 5-mark requirement, what you need to do, you need to write down answer in 5 different points. 5 different points means small 2 to 3 lines paragraphs. And we need to adopt an approach. We need to learn how to prepare this 1 point for 1 mark. These 2-3 lines, 1 point, you must justify for 1 mark. If you are unable to justify 1 mark, whole is lost. If there are 5-mark requirement, there are 2 approaches to answer. Either you can answer in 1 paragraph that started from start of the page and you are continue till end of the page and you have written down everything in 1 paragraph. Or the best approach, make 5 points separately. And then challenge the examiner. I have written 5 points separately, give me 5 complete marks. Even if you have written down all these 5 points in 1 paragraph, it's on examiner whether he can give 3 marks, 2 marks, or 5 complete marks. You cannot challenge the examiner, give me 5 marks. If we are answering in 5 different points, we are challenging the examiner. I have conveyed 5 different concepts separately, so give me 1 mark each. And we need to adopt an approach how to write down 50 good points in the exam answer sheet. If we have written down 50 good points, we can pass this paper. During session, we will practice about 40 to 50 questions. Those questions I have designed, I have picked from past papers. 70% of our paper will be similar to those questions. 30% paper, the examiner requirement could be new, concept will be same. Concept will be same, but he's asking the requirement could be from different nature. The scenario could be of a different type of a company, though we'll able to attempt those 30% paper as well. But the 70% paper will be similar to the questions that we will cover during the session. So what we need to do, the questions we are covering during the question, you need to practice those questions, written practice on the same day or the very next day when we are covering those questions. So that this is 70% paper familiar, we should attempt exact perfect, so that we can score 50 marks easily from this 70% paper. The other 30%, obviously, will be having some idea, will be having concept. Even we'll be able to get 10 marks, we'll be able to pass this paper easily above 60 marks. 100 marks, 100 valid points. Keep in your mind. And this approach we need to adopt while practicing the question. We need to adopt approach. If there is 10 marks requirement, how we can write down 10 different points. If there is a 7-mark requirement, how we can answer in 7 different points. That approach we need to adopt during the session. Are you with me? So we have discussed audit. We have discussed audit process. We have discussed our topic procedure before accepting the audit. So we defined audit. Audit means to express an opinion whether financial statements give true and fair view or not and are prepared according to accounting standards. And in second definition, we define audit means to express an opinion whether financial statements are free from material misstatement or not and are prepared accounting standards. Free from, not a misstatement. I will use the word material misstatement. What is meant by material?
It can influence the economic decision in future.
So let's discuss materiality, our topic. Materiality, in simple word, materiality means significant. Big, large misstatement in the financial statement is called material. The misstatement, if we see, oh, that much misstatement, that is material. If we saw any misstatement in the financial statements and we say, okay, forget about it, ignore it. This means that is not material, that is what? Immaterial. Being auditor, what we need to check in the financial statements, we need to check material misstatement. If there are material misstatement in the financial statement, we will say financial statements do not give true and fair view. And they are wrong because there are big misstatement. If there are misstatement in the financial statements, but they are not material, they are immaterial, we'll say financial statements give true and fair view. In small misstatements, immaterial, we will say financial statements give true and fair view. Who use this materiality concept? Auditor. Nobody else in the world. Who use materiality concept? Auditor. To decide whether he should give opinion in favor of the company or against the company. If there are material misstatement against the company, financial statements do not give true and fair view. But if there are misstatement but they are not material, they are immaterial, who will provide opinion in favor of the company, financial statements give true and fair view despite having misstatement, but they are not material. So let's try to define materiality. What is materiality? Misstatements are material if they influence economic decision of users. In all those misstatements, the financial statements are material if they influence economic decision of user. Economic means decision relating to monetary terms, in money form, in amount form. If a user has seen any misstatement, he is saying, okay, forget about it, This means that is not a material, that is not influencing the user decision. So those misstatements are material if they influence decision of an user, mean big misstatements are material. There is no precise mathematical definition of materiality. It varies from company to company, auditor to auditor. One company whose name is, say, Al Madina grocery store, we found a misstatement of $50,000, and we are saying financial statements do not give trend failure because that 50,000 was material. Another company whose name is Carrefour, we found a misstatement of 10 lakh, 1 million. And we are saying financial statements give trend fair value. This is immaterial. In for Carrefour, 10 lakh is immaterial. For Al Madina, 50,000 is material. Mean there is no precise mathematical definition of materiality. It varies from company to company, user to user. Then how we can judge whether the misstatement we have identified during audit is material or not? Because it's a vary from company to company, user to user. So we can check materiality from two points of view: quantitative materiality and qualitative materiality. Quantitative materiality and qualitative materiality. Quantitative means in terms of amount or size. While conducting audit of any company, we found there was bad debts of $50,000 that has not been adjusted. And there is a misstatement of 50,000. But we need to see whether this 50,000 is material or empty. 50,000 amount. If you want to see whether it is material or not, we can check quantitatively. How we can check quantitatively? In quantitatively, we will apply a rule of thumb. What is the rule of thumb? We will compare this 50,000 with the profit of the company. And if it is 5% or more of profit of the company, we will say material misstatement financial statements do not give trend fair value. It is below than 5% of the profit, we will say immaterial financial statements give trend fair value. This is what quantitative materiality, how we can check. We will apply a rule of thumb. Rule of thumb means comparing with profit. In Al Madina, 50,000 was material. Why? Al Madina profits are in lakhs. So 50,000 was more than 5% of profit. That's why we said financial statements do not give trend fair value. In Carrefour, we identified 10 lakh, 1 million misstatement, but that was immaterial. Why? Because their profits are in billions and trillions. That 10 lakh was not 5% of profit. It was, say, 4% of profit. That's why we said financial statements give trend fair value. In materiality, vary from company to company, user to user. Then how we can judge whether a misstatement that we have identified is material or not? Quantitatively, we can check by applying the rule of thumb. If you want to compare with profit, the threshold is a 5% or more of profit. If you want to compare with the revenue, the threshold is 1% or more of revenue will be considered material. If you want to compare with the total assets of the company, 1% or more of total assets of the company is material. If you want to compare with individual asset class like total debtors, total creditors, then 10% or more of individual asset class will be considered material. Individual asset or liability class will be considered. So during audit, we found 50,000 bad debts was not recorded. First, we will compare with the profit of the company. If it is 5% or more of profit, we will say material misstatement. Suppose we compared with profit, it was 3% of profit, immaterial. We will compare with revenue to see whether it is 1% or more of revenue or not. We found that it is just 0.45% of revenue, immaterial. We'll compare with total assets. We compared with total assets. We found that it's 0.23% of total assets, immaterial. We'll compare with individual asset class, mean total debtors. We compared with total debtors and we found it is 11% of total debtors, material. Financial statements do not give that. If while comparing with all these four thresholds, it is immaterial, we will say financial statements give trend value. Though there is $50,000 misstatement, but we will say financial statements give trend value because this 50,000 is not material. Are you with me? If any amount is not material as per quantitative materiality, we should check a qualitative materiality as well. What is qualitative materiality? Checking materiality in a nature of transaction. Nature of transaction means non-compliance with IAS, IFRS, or law and regulations will always be considered material misstatement, whether the amount is material or not. Non-compliance with IAS, IFRS, or with law and regulation will be considered material misstatement. What is qualitative material misstatement? If any of the misstatement that is immaterial quantitatively, we need to see whether this amount converting company profit into loss or loss into profit, even the amount is a smaller, that will be considered material misstatement. There is a misstatement of $1,000. How much? $1,000. And company is showing $900 profit for the year. They omitted $1,000 expense from the financial statement. If we correct this misstatement, the current year will be $100 loss. Showing loss will be having bigger impact on the company. So they omitted 1,000 so that they can report a profit. Though 1,000 as compared to these immaterial, but as it is converting profit into loss, so from qualitative point of view, it will be considered material misstatement. Are you with me? IAS 1 says director transaction should be disclosed in the financial statement. And if directors have performed any transaction with the company, they need to provide disclosure in the financial statement. Related party per IAS. Related party standard is what? IAS 24. IAS 24 related party transactions. Even IAS 24 says related party transactions should be disclosed in the financial statements. Company directors performed $1,000 transaction with the company, and they haven't provided disclosure in the financial statements by saying it will not look nice like 1,000 transaction we have performed and we are disclosing this fact. Though 1,000 is nothing from quantitative point of view, but it is a non-compliance with accounting standards, so this will be considered as material misstatement. Are you with me? So we discussed what is materiality, who use auditor, who decide whether he should give opinion against company or in favor of the company, and how we can check materiality quantitatively and qualitatively. There are some limitations with this materiality standard. The standard on materiality is ISA 320. ISA 320. We should memorize these standards number as well. So the all concept we have discussed is as per ISA 320. There are some problem with ISA 320. Is a threshold that we have defined 5% or more of profit. In fact, standard have defined 5 to 10% or more of profit will be considered material. 0.5% to 1% or more of revenue will be considered material. 1% to 2% or more of total assets will be considered material. 5% to 10% or more of individual asset or liability class will be considered material. If suppose we compared with the revenue and the amount is 0.7% of revenue, whether we should consider it material or not. Because standard is saying 0.5% to 1% or more of revenue will be considered material. So we need to apply judgment. Because the threshold are not clearly defined. This is one issue with the ISA 320. Second issue with ISA 320, they are saying those misstatements are material if they influence the decision of user. Who are user? Bank, customer, supplier, government, prospective investor, student, if they are studying financial statements of any of the company. Who are the user? From which user point of view, we need to check whether it is influencing user decision or not. So this is again problematic. We need to apply judgment because the word user is not clearly defined. Some accounting standard says like IFRS 16 on leases. IFRS 16 says if company is involved in leasing, they need to provide appropriate disclosure in the financial statement about leasing. What is meant by appropriate disclosure? 6-line disclosure, 10-line disclosure, 2-line disclosure, 50-line disclosure. Because if there is appropriate disclosure, financial statements give trend fair view. If there is no appropriate disclosure, financial statements do not give trend fair view. And that appropriate word is not defined. We need to apply judgment whether it is appropriate mean no misstatement, inappropriate mean misstatement, whether it is material or immaterial, how much information they have given, how much they haven't given. So we need to apply judgment. So there is some problem with ISA 320 materiality threshold are not clearly defined. The word user is not clearly defined. And according to some accounting standard, even the appropriate disclosure word is not clearly defined. So we need to apply our judgment. Are you with me? So we have discussed materiality. Now moving toward discuss another concept called performance materiality. Performance materiality means setting materiality below the materiality of a whole financial statement. Setting materiality below than materiality of whole financial statement is called performance materiality. What does that mean? Let's discuss. At planning stage, while highlighting risky areas, auditor also define some preliminary materiality levels. Materiality levels. How? He checked the financial statements, the figure of financial statements profit. He calculated 10% of a profit and he write down an amount. He calculate 1% of revenue and he write down an amount. He calculate 1% of total assets and write down an amount here. and give these amount to the auditor team. If you are identifying any misstatement, compare with these amount. If your misstatement is below than these amount, consider it is immaterial. If it is above than these amount, consider it material. Instead, you are checking percentage. So these materiality levels that we have defined at the planning stage, these are called preliminary materiality levels, or these are called materiality of a whole financial statement that we set at start of the audit at planning stage. And we have set these materiality level for the audit team. Instead, they are calculating percentage. We have calculated 10% of profit, 5% of profit figure, 1% of revenue figure, 1% of total assets figure. And we have asked the audit team, if you are finding any misstatement below this amount, ignore. Any misstatement above this amount, consider it material. These are what? Preliminary materiality or materiality of whole financial statement. What happens sometime during audit? Audit team is finding some misstatements. While comparing with these are immaterial. Be not material. What performance materiality concept says? If you are finding some immaterial misstatement during the audit, and they are so many in a numbers, don't ignore them. Prepare their list. At the end of audit, check their combined performance. In total, in aggregate. If in aggregate the total is becoming a material, consider it material misstatement, not individually, in aggregate. Checking the combined performance of all individual immaterial misstatement at the end of audit is called performance material. This is one concept of performance materiality. Now, according to the definition, what is concept? See, if at the planning stage, we calculated profit materiality based on 5%, we calculated revenue materiality based on 1%. And during audit, we found so many immaterial misstatement that was not material as per these amount. What performance materiality concept says, you should reduce your preliminary materiality. If you calculated this figure based on 1% of revenue, now calculate this figure based on 0.5% of revenue. If you calculate this figure on 10% of profit, now move towards 5% of profit and check whether these immaterial figures are becoming material or not. When we are changing our initial preliminary materiality level during the audit, because we are finding so many immaterial misstatement, changing how we are changing, we are reducing them. Instead of 1% of revenue, we are moving towards 0.5% of revenue. This is called performance materiality, means setting materiality level below than the materiality of whole financial statements. Reducing the preliminary materiality levels during the audit. This is called performance materiality. Either consider the aggregate of individual material misstatement, immaterial misstatement at the end of audit, or reduce the preliminary materiality level. This is called performance materiality. What is best? Reducing the preliminary materiality. What is preliminary materiality? Performance materiality. Setting materiality below than the materiality of whole financial statements. At planning stage, whatever the preliminary materiality we defined, now reducing that, instead of 1% of revenue, moving towards 0.5% of revenue. Instead of 10% of profit, moving towards 5% of profit. This is what? Performance materiality. ISA 320 allows the auditor to change their preliminary materiality levels. We can change our initial materiality level that we have defined at planning stage. Under what circumstances? In case of performance materiality. Performance materiality mean if we are finding so many immaterial misstatement. If during audit we are aware there are chances of fraud, we should reduce our preliminary materiality levels. If during the audit there is a change in structure of the company, structure mean company have acquired any other subsidiary, now it is becoming group company. This profit revenue figure we calculated on single company. Now we should calculate these materiality on both the company results, so we can change materiality during the year. Mean preliminary materiality level can be changed during the audit in case of performance materiality, in case of finding fraud, or in case of change in structure of the group. Mean you are adding new subsidiaries, you are disposing any subsidiary, you are acquiring any company, becoming a group. This means these materiality we need to change as per the existing number of companies in the group. So we have discussed about materiality. Let's take a break. After break, we will discuss we'll start one very important area of this paper, audit report. Advanced audit and assurance. We have discussed about audit. The name of the paper is advanced audit. What is audit and what is advanced audit? Same audit. We have studied audit and assurance at skill level. That we have studied while sitting at senior junior level. Now we should think about audit at key audit personnel, mean engagement partner and manager level. So that's why it is called advanced audit. What is assurance? That we will discuss somewhere. In simple word, assurance means confidence. In audit, we are providing opinion. In opinion, we are providing assurance, not guarantee. If we are saying financial statements give and fair view, we are providing an assurance rather than guarantee. We are providing a confidence. We will discuss about assurance somewhere else. Okay, let's move towards AAA paper is having 5 main areas that we need to cover. One area is relating to audit report. Normally, examiner test this part in part B of the paper, like 25 marks question. The other area is audit planning and risk. And this normally examiner test in question number 1. The first question. The third area is ethics and other professional issues. This normally examiner test in small question like 25 marks question. The fourth area is non-audit engagements. That will cover at end of the syllabus. This is also normally examiner test in 25 marks question. And the fifth area is matter plus procedures or evidence. And this is the area where student struggle. And this area decide pass or failure of your paper. Because it's a little bit technical. Sometimes examiner asks to write down procedure, but what student does, they are writing evidence. Sometimes he asks to write down evidence, but procedures doing, they are writing down procedures. We'll differentiate. So we are going to start from this area. After completing this area, we will work on this area. Then we will work on this area too. And then at the end, we will cover this area and this area that we will cover alongside here, here, as well as a part. I mean, this will automatically be covered. Our session will be of 3 months, probably mid of February. Till mid of February, we'll be able to complete each and everything. I'm preparing you for March 2025 attempt. I'm expecting you are going to attempt this paper in March 25. You'll be able to prepare easily. You'll be able to prepare easily. You can attempt 2 papers in March, there's no issue. Both are different theory-based papers. Being a full-time student, you can attempt 2 papers. There is no issue. SBL, AAA, both can be attempted in March if you have covered SBL. Because this will be able to cover during the classes. At home, what you need to do, just practice, just written practice the question that we have covered in the class. Nothing else. Okay, so we are going to start audit report area. So audit means to express an opinion, whether financial statements give true and fair view or not, and are prepared according to accounting standard. Where we express the opinion on a page. That page is called audit report. In the final outcome of the audit is what? Audit report, where we express the opinion. So we're going to discuss how many types of audit report are there and under what circumstances auditor issue what kind of report, what type of report. So we are going to discuss types of report. The first type of audit report is a standard worded unmodified report. Standard worded unmodified report. There is a standard ISA 700 who have written down our report wording already. And this standard is saying, if you want to express opinion in favor of the company, meaning you want to say financial statements give to and fair view and are prepared according to accounting standard, what you need to do, this ISA 700 standard wording report, just copy paste as it is. Don't need to write anything, don't need to change anything, don't need to amend anything. Just put the company name, its year end, and put your name, signature at the end of the report. What else should be in the report? It's already written down by the standard. So standard worded unmodified report. If you want to express opinion in favor of the company, when you want to say financial statements give to and fair and are prepared according to company standard, what we need to do, this is ISA 700 standard worded report. We need to issue as it is without any change. Just we need to fit the company name, its year end, and our name and signature at the end and date. What else should be in the report? It's already written. It's already written here. Financial statements give to and fair view and are prepared according to company standard. So this is the first form of audit report, standard worded unmodified. Now, if we want to express opinion against the company, we want to say financial statements do not give to and fair view. This means in a standard report, it is written financial statements give. We want to say do not give. This means we are going to modify the report. The report will be modified if you are going to change the wording of standard wording report. Instead of give, you are going to change it, do not give. So we are going to modify the report. Our report can be modified. You want to say financial statements give to and fair view and are prepared according to accounting standard, but you want to add something in the report from yourself. You want to add any extra paragraph from yourself. If you are going to add any paragraph in the audit report from yourself, you are going to change the standard length from here to here. This means you are modifying the report. So audit report can be modified in two forms. One with qualified opinion. Qualified means giving opinion against the company. Unqualified opinion means giving opinion in favor of the company. Qualified means against the company. Mean we are going to change the wording of the report. Our audit report can be modified. Opinion will remain same, unqualified. But we want to add any extra paragraph from ourselves in the audit report. If we are going to add paragraph, ultimately we are going to change the standard length of the report. So the report is going to be modified. So let's discuss if we want to keep the opinion in favor of the company. Mean we want to say financial statements give to and fair view and are prepared according to accounting standards, but we want to add any paragraph in the report. That paragraph could be of two types. One is emphasis of matter paragraph. The other could be other matter. When we should use which paragraph, let's discuss. Emphasis of matter paragraph. If there are some matters in the financial statements that are correctly presented, disclosed, but we want to put into shareholder attention. We want to highlight matters of financial statements in audit report to put into shareholder attention. Why? Because might be shareholder take decision while reading only the audit report. They don't see the financial statements, or they don't know how to read the financial statements. So to help the shareholder regarding any matter that is important for him in the financial statements, we want to highlight for him How we will highlight in the audit report by including a emphasis of matter paragraph. Emphasis of matter mean any matter in the financial statements that we want to emphasize. Emphasize mean highlight in the audit report. For whom? For shareholder. Just for his help. Why? Might be he has overlooked that matter. This matter is important for him. This matter could influence his decision. So we should help him. The matters relating to him, we should highlight for him in the audit report. How we can highlight? By including emphasis of matter, by adding emphasis of matter paragraph in the audit report. Opinion will be in the favor of the company. Mean financial statements give and fair and are prepared according to accounting standard, but please pay attention on this matter in the financial statement as it could influence your decision. Why we are highlighting? Might be he don't know how to read the financial statement, or he is just taking a decision based on audit report. He is not checking the financial statements. So any matter in the financial statements that is important from shareholder point of view, we should highlight in the audit report by including emphasis of matter paragraph. That matter is correctly presented, disclosed in the financial statements. That's why we are giving opinion in favor of the company. If any matter is wrong, we will qualify the opinion. We will not highlight through emphasis of matter. That matter is correctly presented, disclosed. Financial statements give and fair view. Just we want to put that matter into shareholder attention. So we'll put into his attention by including emphasis of matter paragraph. What could be these matters? What are the examples of emphasis of matter? For IAS 1, company should prepare financial statements on going concern basis. Going concern basis means normal. If company is going concern. For IAS 1, if company is going concern, company should prepare financial statements on going concern basis. But if company is not going concern, company should prepare financial statements on breakup basis, realization basis, also called liquidation basis. If company is not going concern, management have prepared financial statements on breakup basis. This means financial statements give and fair and are prepared according to accounting standard. But financial statements have been prepared on breakup basis mean company will shut down their operation within 12 months. We should put this into shareholder attention. How? By highlighting through emphasis of matter paragraph. Mean he should not invest more money into the company because company is not going to continue its business in next 12 months. Or IAS 1 says if company is having any cash flow issue, if they are struggling to manage their short-term cash flow, they need to provide a disclosure in the financial statement. So company prepared financial statements, they were having some cash flow issue and they have provided the disclosure of cash flow issue. So financial statements give and fair and are prepared according to accounting standard. But this cash flow issue disclosure is important from shareholder point of view. He should hold further investment in this company until this cash flow issue resolved. So we should highlight this cash flow issue from shareholder point of view, the audit report. How? By including emphasis of matter paragraph. Are you with me? Another example, suppose company is facing a legal claim from any of the party. And for IAS 37, if that claim is meeting 3 conditions of provision: present legal constructive obligation from past event, probability of future economic outflow, and amounts can be measured reliably, there should be provision. But if there is no probability, there is a possibility, company should provide contingent liability disclosure. There was a case, as per accounting standard, it was not meeting the condition of provision. There was no probability, there is possibility. So company have provided contingent liability disclosure in the financial statement. Mean there could be company will lose the case and company might pay the amount. For IAS 37, we check financial statements are true and fair. provision is not required, contingent liability disclosure was required, that they have provided. This means financial statements give to and fair view and are prepared according to accounting standard. But as per the severity of the case, we realize if company lose this case, there will be huge cash outflow that company need to make. That could affect the company future survival. This means this contingent liability disclosure is significant from shareholder point of view. He should wait for further investment in this company until this issue resolves. So we will highlight this contingent liability disclosure from shareholder point of view in the audit report. How? By including into a emphasis of matter paragraph. In financial statements, give and fair and are prepared according to accounting standard, but please pay attention on a note dash in the financial statements for contingent liability, as it could affect materially in future of the company, could impact materially in future of the company. So those matters presented disclosed in financial statement, and they are correctly presented disclosed. If we are considering they are important from shareholder point of view, means they are significant, we should put into shareholder attention. How we can put financial statement matter into shareholder attention? By including emphasis of matter paragraph in the audit report. And one thing very important, whenever you are including emphasis of matter paragraph in the audit report, your opinion should always be unqualified. We never ever use emphasis of matter with qualified opinion. And this is a big blunder that most of the students make it while answering the question of audit report. Will qualify the audit opinion, and this matter should be highlighted through emphasis of matter paragraph. Emphasis of matter will always come with unqualified opinion, even other matter as well. In certain circumstances, other matter can come with qualified, but mostly with unqualified opinion. So those matters which are presented disclosed in financial statement, if we want to highlight in the audit report, we will use emphasis of matter paragraph. If we want to highlight matters other than financial statement, we will use other matter paragraph. To highlight matter presented disclosed in the financial statement, we will use emphasis of matter. To highlight matter other than financial statements, auditor use other matter paragraph. What could be the example of other matter paragraph? Every year, company produce their annual reports. That they present to the shareholder at the EG. What includes annual reports? In annual reports, there are financial statements. In annual reports, there are chairman, CEO statement. In company chairman and CEO, they provide their statement in the annual report, like they are expressing their views about the company, from how long they have been associated with the company, what they have done in best interest of the company during the past year. They provide their statement. This is compulsory as per corporate governance. Also, there are directors' statement. Directors mean committee's statement. In every director provide their statement, how we are performing within the company, how we are contributing towards the company. If company have performed any social environmental responsibility, that social environmental responsibility is called a CSR report. That is also part of annual report. We being auditor need to express opinion on what? Financial statement, not annual report. This means we need to give opinion on financial statements. We need to verify figures of financial statements. We need to take evidence of financial statement. But there is one auditing standards, ISA 720, other information. That ISA 720 other information says, though we need to audit, we need to express opinion on financial statements. But this other information in the annual report, we need to read and review. Not audit, we need to read or review. Why we need to read or review? Just to see whether there is any inconsistency with the financial statement. If there is any inconsistency, we should highlight in the audit report through other matter paragraph. Like in chairman's statement, Mr. Chairman is saying, during the current year, we have doubled the company profit. Doubled mean 100% increase. While checking financial statements, company prepared financial statements comparatively, mean along with current year previous year figures are also stated. We checked profit has increased by 20% only. We verified the financial statements profit has been increased by 20%, mean financial statements give and fair view. But this rascal is saying we have doubled the profit. We discussed with him, Mr. Chairman, please, it's not doubled. It's just 20%. Please change your statement. He didn't bother. This means this other information is inconsistent with the financial statement. Because financial statements we have verified, we have evidence for each figure, financial statements are accurate. This other information is wrong. So we need to highlight this in audit report, not using faces matter, because this is not matter of financial statement. This is matter of other than financial statements. So we'll highlight through other matter paragraph. So when we will use other matter paragraph, if other information is not consistent with the financial statement, we will use what? Other matter paragraph. One example. Okay. Other example. Who appointed the auditor? Who appointed the auditor? Shareholders. This means our audit report is for whom? Mainly shareholder. If due to negligent work, we have expressed wrong opinion, and different parties have made decision based on our audit opinion, and after that it was found our work was negligent, our opinion was wrong, and they lost their money like investment. To whom we are liable? Mainly to shareholder. But we are not only liable to shareholder, we are liable to other stakeholder as well. Other stakeholder could demand for damages as well if our opinion proved wrong due to our negligent work. This means in case of negligent, auditor liability is not limited towards shareholder. He will be liable towards other stakeholder as well. But if auditor want to limit its liability towards particular stakeholder, like I will be liable for shareholder only. If anybody else want to take a decision based on audit report, they should perform their own investigation. I will not be liable for you people. I will be liable for shareholder only. Auditor can make limit to his liability by including other matter paragraph. So other matter paragraph can be used if auditor want to limit its liability towards particular stakeholder. In case of auditor limiting liability towards particular stakeholder, auditor will use other matter paragraph. If auditor is asked to report on two set of financial statements for the same company, it happens in group audit. If you are auditor of parent company is preparing two financial statements, one individual results of parent company and one consolidated financial statements. So we are expressing opinion on both financial statements separate. We are signing a report of both financial statements separate. So we should include other matter paragraph in both audit report. In individual, we should include other matter. We have expressed opinion on consolidated financial statements of this company as well. In consolidated report, we will include other matter. We have expressed opinion on the individual results of this parent company as well. So if auditor expressing opinion on two set of financial statement for same company, so we should use other matter. Another example, if you are going to conduct audit of any company for the first time, we should always use other matter paragraph in our first audit report to highlight previous year financial statements were not audited, or if previous year auditor was different, we will highlight previous year financial statements were audited by any other firm. In our first audit report, we should always include other matter paragraph. If company is going for first time audit, we will say previous year financial statements were not audited. But if previous year auditor was different, now you have been appointed as auditor. In first audit report, we will say previous year financial statements were audited by any other firm. We don't need to name that firm. So if previous year financial statements were not audited, or audited by any other firm. So we should use what? Other matter paragraph. So we are discussing about types of audit report. The first type of audit report is standard worded unmodified report. When we want to express opinion in favor of the company, we should issue ISS 700 standard wording as it is, without any change, without any addition. The other audit report is a modified report, and report can be modified in two ways. Either by qualifying opinion in changing the opinion wording, or with unqualified opinion by adding a paragraph, and that paragraph could be emphasis of matter or other matter paragraph. When we should use emphasis of matter paragraph? If we want to highlight any matter of financial statement that is presented, disclosed in financial statement, correctly presented, disclosed in financial statements, and we consider it is important from shareholder point of view, we should help him by putting into his attention. How we can put into his attention? By highlighting in audit report through emphasis of matter paragraph. Example, if there is any cash flow disclosure in the financial statements, we will highlight by using emphasis of matter paragraph. If there is any significant contingent liability disclosure in the financial statements, we will highlight through emphasis of matter paragraph. There is any early adoption of accounting standards. And there is a new accounting standard that is going to be applicable on companies after 2 years. But company have applied that standard from this year, and due to that application, there is some significant change in the figures of different account balances. So we should highlight this through emphasis of matter paragraph. If we want to highlight any matter other than financial statements, we will use other matter paragraph. For example, we have discussed, if other information in the annual report is not consistent with the financial statements, we will use other matter paragraph. If auditor want to limit its liability towards particular stakeholder, we will use other matter paragraph. If auditor is reporting on two sets of financial statements for the same company, we will use other matter paragraph. If previous year financial statements were not audited or audited by any other firm, we will use other matter paragraph. This first example, I am highlighting it. We will discuss on it something different later on. Till now, it's example of other matter, but we will discuss something different on it as well. So we have discussed two types of audit reports: standard worded unmodified report and unqualified report with a paragraph. Now we are moving towards other types of audit report, that is through qualified opinion. The opinion can be qualified. Qualified means expressing against the company. The opinion can be qualified due to two reasons. One is disagreement with management, and the other is a scope limitation. Disagreement with the management means there is a misstatement in the financial statement that we have identified. We have communicated to management. We have requested them to correct it, but they didn't bother to correct it. They are not agreeing with us to correct that misstatement. I mean, there is material misstatement in the financial statement, and we are having evidence there is misstatement, but management is not correcting that. This means financial statements are wrong. This is what a disagreement with the management. We need to see whether that misstatement is material only or material as well as pervasive. Misstatement is material only mean that misstatement is affecting only a particular account balance. The rest of financial statements are correct. Mean there is misstatement in inventory, the other thing is correct. There is misstatement in wages, the rest financial statements figures are correct. Only the sale is overstated, the rest financial statements are correct. Only the depreciation of asset is not recorded, other things are correct. So we'll say, except for inventory, financial statements give true and fair view. Except for wages, financial statements give true and fair view. Except for depreciation of non-current assets, financial statements give true and fair view. This is called qualified report. But if the misstatement is material as well as pervasive, pervasive mean affecting the whole financial statement. Mean inventory is overstated, wages are also understated, sale is also overstated, mean not only one account balance, there are so many account balance that are materially misstated. And this misstatement is not only material, it is pervasive, mean pervade, spread throughout the financial statements. In that case, we will say financial statements do not give and fair view, mean we will issue adverse report. So auditor qualify opinion, mean provide opinion against company in two situations, in two reasons. The first reason is disagreement with management. Disagreement with management means there is a material misstatement. We are having evidence there is a material misstatement. We ask the management to correct, but they are not correcting it. We know per IAS 36, if your asset carrying value is higher than recoverable amount, you need to impair the asset. We ask the management for impairment, but they are not impairing it. Mean due to that, asset profit is overstated and expenses understated. This is what material misstatement. Because this standard reference is evidence. Per IAS 38, research cost should be expense out, development cost should be capitalized by meeting criteria. There was a development cost, but that was not meeting criteria of commercial viability. But management have capitalized it instead of expense out. We asked them, this is not meeting criteria of development cost, please expense out. But they are capitalizing it, mean asset profit is overstated and expenses understated. This is what disagreement with management. For IAS 37, if there is a probability, you need to recognize the provision. If there is a possibility, you need to provide contingent liability disclosure. The matter was meeting all three conditions of provision. There was probability, but instead of provision, they disclosed contingent liability. We asked them to correct, please provide provision. They didn't bother. This is what material misstatement mean, disagreement with management. Mean either we have found evidence, based on that we can say there is material misstatement, or there is a non-compliance with accounting standard. So that accounting standard reference is evidence for us and management is not changing the financial statements, they are not bothering on our request, mean they are not working on letter of weaknesses. So this is what disagreement with management mean material misstatement. So we need to see whether that misstatement is a material only or material as well as pervasive. If one account balance is affected due to that misstatement, we will consider it a material. Even we need to check the materiality, 5% or more of profit amount is material or not. And if more than account balances are affected, mean there are so many material misstatements, we will consider it pervasive. This materiality and pervasiveness is judgmental sometimes. We are saying there is problem in inventory only. So we'll consider it a material and we will say, except for inventory, financial statements give time fair view. But if suppose the company is manufacturing company is a trading company, the main account balance for manufacturing or trading company is what? Inventory. Inventory is overstated by 90% of the amount. Then this inventory is not only material, it is pervasive as well, because inventory is recorded in income statement, recorded in balance sheet, recorded in cash flow statement as well. Then this inventory misstatement will be considered pervasive as well. We will say financial statements do not give trend fair. Mean adverse opinion will express, adverse report. So auditor qualified opinion due to two reasons. First reason is disagreement with management, mean there is material misstatement. If there is immaterial misstatement in the financial statement, what we will do? On standard verdict on modified report. If there is a material misstatement, then qualified report. Material plus pervasive means so many material, then adverse. If there is immaterial misstatement, standard verdict, unmodified report. The other reason for qualifying opinion is what? Scope limitation. It is also called inability to obtain sufficient and appropriate audit evidence. We being auditor should obtain sufficient appropriate audit evidence before expressing the opinion. If we are having evidence, we should say this is right, this is wrong, because we'll be able to justify that. If we don't have evidence, we should not say this is right, this is wrong. We should keep our mouth shut, because without evidence, we will not be able to justify our opinion. And this is what situation where we don't have evidence. There is scope limitation. Scope limitation means management do not allow access to the records. If they are not allowing access to the records, obviously we are unable to perform procedures. If we are unable to perform procedures, we are unable to get evidence about the figures. Because evidence we can get while performing procedures. Procedure we need to perform where? On financial statements, financial records. If we don't have access to the records, management is not allowing, or might be records are not available. They have been destroyed by flood. They have been destroyed by fire, or they have been stolen by any of the past employee. No records. We cannot perform procedure. We cannot take evidence. We cannot verify figures. This is what scope limitation. Our company system was computerized and computer system crashed, destroyed all the records. Nothing there to verify. So in that case, we need to see the evidence we haven't obtained is of material nature, mean relating to any particular account balance, mean only inventory record has been destroyed, the rest everything we have verified. Only wages record has been destroyed, the rest we have verified everything. In that case, except for opinion, mean qualified report. But if the whole system is crashed, nothing we able to verify, in that case, the scope limitation is not material nature. It is relating to whole financial statements, mean pervasive nature. In that case, we will issue disclaimer report, mean we do not express any opinion. Why? Because we don't have evidence. We can say this is right, this is wrong based on evidence. If we don't have evidence, keep our mouth shut. We do not express any opinion. Disclaimer report. So there are 5 types of audit report. First, standard worded unmodified report. Second, unqualified report with a paragraph. Third, qualified report either due to material misstatement or either due to scope limitation. Fourth, adverse report. And fifth, disclaimer report. If there is a reason of material misstatement and there is a material misstatement not pervasive, we will issue qualified report. Qualified means except for. If the misstatement is material as well as pervasive, adverse report. And due to scope limitation, if the scope limitation is of material nature, mean particular account balance we are unable to verify. The rest we have verified, the nature is material, qualified report. Except for this, financial statements give 10 review. But if we are unable to verify anything, mean the scope limitation is of pervasive nature. In that case, disclaimer report, we do not express any opinion. The wording is important. So we have discussed the 5 different types of audit report. Standard wording unmodified report, when we want to issue report in favor of the company. What we need to do, the ISS 700 report, we need to issue as it is. Just copy paste the wording of ISS 700. Just put the company name, its year end, and put your name, signature, date. You don't need to write down anything because everything is written by the standard himself. It is already written in the report, financial statements give 10 review. Or we can modify the report, and modify report can be modified in 2 ways, either by changing the wording of the opinion or by adding paragraph in the audit report. That paragraph could be faces a matter to highlight matter presented disclosed in financial statement or to highlight matters other than financial statement. What are the examples of faces a matter? To highlight disclosure of cash flow issue in the financial statement, to highlight any contingent liability, any significant contingent liability disclosure in the financial statement, or to highlight any early adoption of accounting standard having significant impact on the financial statement. What are the examples of other matters? If other information in the annual report is not consistent with the financial statement, if auditor want to limit its liability towards particular stakeholders, if auditor express opinion on 2 set of financial statements for the same company, and if previous year financial statements were not audited or audited by any other firm. The opinion can be qualified in 2 situations: due to material misstatement or due to scope limitation. Scope limitation means inability to obtain audit evidence. If the matter means there is a material misstatement, qualified report; pervasive misstatement, adverse report. Material scope limitation, qualified report; pervasive scope limitation, disclaimer. So we have discussed different types of audit report. Now let's discuss what is in the audit report. And we are going to discuss contents of audit report. Contents of audit report. We must be familiar about contents of audit. The first content of audit report is what? Title. And the audit report title is always independent auditor's report. And the addressee of the audit report are shareholder or member. Like independent auditor's report to shareholder of ABC company. Independent audit report to members of ABC company. Title, addressee. Audit report title, independent auditor. Word is used. And to whom we address? Members or shareholder. After that, there is what? Opinion paragraph. The paragraph in which we express the opinion. But before opinion, expressing opinion, there is some introduction of the company. We will put the name of the company, its year end, and the name of financial statements components that we have audited. Name of company, its year-end, and the name of financial statements component like statement of comprehensive income, statement of financial position, statement of cash flow, statement of changes in equity, and notes to the accounts that we have audited. And then we will express opinion whether financial statements give true and fair view or not and are prepared according to accounting standard. After opinion paragraph, there is a paragraph called basis for opinion paragraph. Basis for opinion paragraph. Few years back, this paragraph was used only if we are expressing opinion against the company. In why we are providing qualified report, we need to explain the reason in basis for opinion paragraph. Why we are providing adverse report, we need to provide the reason in basis for opinion paragraph. Why we are moving towards disclaimer report, we need to provide the reason where in basis for opinion paragraph. Now, standard is saying this paragraph you need to include in audit report even you are expressing unqualified opinion. In case of qualified opinion, you need to explain the reason. But in case of unqualified opinion, why this paragraph is necessary? To highlight 3 points. First, work performed as per ISAs. I have performed audit work as per ISAs. Second, I have maintained my independence throughout the audit. I have performed work independently. And third, I have obtained sufficient appropriate audit evidence to base on my opinion. Opinion is based on sufficient appropriate audit evidence. If you are expressing opinion in favor of the company, we need to discuss these 3 points. But if we are expressing opinion against the company along with these 3 points, we need to explain the reason behind qualifying the report. And in that case, we need to explain the matter in the issue, whether inventory is overstated or understated, whether depreciation is not recorded, whether there is a scope limitation due to record destroyed, the matter we need to discuss. If there is any accounting standard involved, we need to state the accounting standard as well. Company haven't impaired the asset. So we'll say as per IAS 36, asset need to be impaired when carrying value is higher than recoverable amount. We need to provide the amounts. How much was the impairment that was not recorded? We need to provide the effect on financial statement. Due to this impairment, profit was overstated by how much amount, asset was overstated by how much amount, expenses are understated by how much amount. And we need to provide the justification how we have treated the matter as material as pervasive. And if we are going towards qualified report, this means matter is material. So we need to explain how this matter is material. Whether it is 5% of profit, 1% of revenue, how it is material. If we are going to express adverse report, we need to explain how we have considered the matter is pervasive. Either more than one material misstatement or the single is having big impact on the financial statement. So in case of unqualified opinion, we need to state 3 points under basis for opinion paragraph. We have performed work as per ISAs. We have maintained our independence throughout the audit, and our opinion is based on sufficient appropriate audit evidence obtained. But if we are going to provide a qualified opinion, either qualified, adverse, or disclaimer, in addition to these 3 points, we need to explain 5 more points. We need to state the matter on which we are going to qualify the report, accounting standard, if any involved, we need to explain what accounting standards say in this particular situation and what the company have done. What is the amount of misstatement that we need to provide? And what is effect on the financial statement due to this misstatement? Mean profit, revenue, total assets is affected by how much amount. We need to provide the effect, and we need to provide the justification how we treated the matter, material or permissive. Where in basis for opinion paragraph. Leave this paragraph for a while. After that, there is a paragraph called key audit matter. Stands for CAM, key audit matter. In audit report, we need to include a paragraph called key audit matter. What is meant by key? It's not log key. Key means important, significant. Important, significant matter from audit point of view. Mean the areas of financial statements where we have performed so much detailed work, where we have spent too much time in verifying the figures. That is called key audit matter. We need to highlight key audit matter in the audit report. So what is key audit matter? Key audit matter could be high risky areas that we have identified risky at the planning stage. Material account balance, material mean large amount account balance. Are the areas risky according to auditor judgment? In auditor experience says, in this particular type of company, these are the account balances where there are always chances of high misstatement. So those will be called what? Key audit matter. Are the areas account balance whose figure is based on estimate and judgment? Whose judgment and estimate? Company management. And there are always chances of high misstatements. So those will be called what? Key audit matter, on which we have performed so much detailed work, will be called key audit matter. How we need to disclose this paragraph in the audit report? We need to put the heading of the matter, whether it is goodwill, we'll put the heading goodwill. Along with, we need to explain why it is CAM. Mean whether it is a high risky area, whether it is involving judgment estimate, or whether it is a material account balance. And we need to explain brief audit approach, mean how we have audited these areas during the audit. Mean what procedures we have performed to verify these areas. Mean what we need to disclose under CAM, the matter, the reason why it is CAM, and brief audit approach. Why CAM? Why we need to provide CAM in the audit report? What's the reason? To meet a transparency from auditor point of view. Everything should be disclosed transparently. We are going to disclose the areas where we have performed too much work during the audit. For user better understanding. Better understanding of user of the report. They will be aware, oh, these are the areas that were high risky during the year where auditor have performed too much detailed work. Let's see how they have verified. Okay, they have verified properly. Now they can take a decision in better way, or to improve audit quality. If auditor is aware, I need to highlight key audit matter in the audit report, as well as I need to explain my audit approach. So to build a good repute, to show a good audit approach, he will verify these area in more detail, because he need to explain his approach in the audit report. And through this, the high risky area will be verified properly. This will improve the audit quality. No CAM, where the audit matter section is not required. CAM is required for listed company audit report. For unlisted company, it is not required. If we have expressed adverse or disclaimer report, what we are saying, financial service do not give and fair view. I mean, everything is wrong. Is there any key audit matter left? Because the reason we have explained in basis for opinion paragraph. So in case of adverse report, or in case of disclaimer report, if relating to whole financial statements, everything is wrong. So there is no need to highlight CAM. Because in CAM, we are highlighting only those areas that are correctly presently disclosed. They are correct. We have verified them. And we are explaining our audit approach. We are highlighting, oh, these were the areas that we have verified properly, and this is their approach. If any area was wrong in the financial statements, on that we have qualified the opinion. That area we have explained where in basis for opinion paragraph, there is no need for repeating under CAM. Are you with me? If a company is small, having minimal account balances means small account balances mean immaterial. So there is no key audit matter. We don't need to include key audit matter section in the audit report. So what is a CAM? What we need to disclose under CAM? The matter, the reason why it is CAM, and brief audit approach. Why we need to provide this CAM section in the audit report, and where we can avoid CAM, mean no CAM. So we are discussing contents of audit report, title, addressee, opinion paragraph, basis for opinion paragraph, key audit matter. And then there is a paragraph called other information paragraph, not other matter. Other information paragraph. This will be included in the audit report compulsory. Relating to other information in the annual report. We have discussed 4 examples of other matter paragraph. The first example was if other information is not consistent with the financial statement. This is not an example of other matter now. We will discuss relating to other information, the annual report, where in other information paragraph rather than through other matter paragraph. If other information is consistent with the financial statement, we will say there is no material misstatement in other information. But if other information is not consistent with the financial statement, we will say there is a material misstatement in other information. As chairman saying, we have doubled the profit while financial statement is showing only 20% increase in profit. And we need to highlight 3 things in this other information paragraph. First, there is our duty to read or review this other information per IAS 720, but do not audit. Read or review, but do not audit. Second, our opinion is not influenced by this other information, because our opinion is always on financial statement. And third, there is no material misstatement of other information if it is accurate. There is a material misstatement of other information if it is inaccurate. What are the example of other matter paragraph? The remaining three are example of other matter paragraph. If auditor want to limit his liability, if auditor expressing report on two set of financial statements for the same company, if previous year of financial statements not audited by any other firm, these are examples of what other matter. But relating to other information, there is a separate paragraph in the audit report called other information paragraph, where we will highlight 3 points. It is our responsibility to read or review this other information per IS 720. Our audit opinion is not influenced by this other information. And if it is correct, there is no material misstatement of other information. If it is wrong, there is material misstatement of other information, and we need to explain why it is wrong. After the information paragraph, there is a paragraph called management responsibility, where we will state management responsibility. Who is responsible for preparing financial statements? Company management. Who will implement internal control system in the company? Company management. Who will provide access to company records and information relating to audit to the auditor? Company management. Why we are highlighting these management responsibility in the audit report? To avoid expectation gap. What is expectation gap? Expectation gap is a difference between public perception and auditor's true responsibilities. Public think that financial statements auditor prepare. No, it is responsibility of company management. We are highlighting in the audit report just to clear this expectation gap. Public think like auditor implement internal control system. No, this is responsibility of company management that we are highlighting in our report. These are not our responsibilities. Who should follow accounting standard? Company management, not the auditor, because they need to prepare financial statements. Then we need to explain auditor's responsibility paragraph. If we are saying financial statements give to and fair view, we are not providing guarantee. We are providing assurance. Even that assurance is what reasonable assurance we highlight here. We do not verify things 100%. We perform procedure on sample basis, mean we obtain sufficient appropriate audit evidence. We plan our work and we evaluate internal control system, and then we decide either we should audit on system-based approach or substantive approach. We evaluate the client estimate and judgment to see whether they are reasonable or not. Mean what we do, we state under auditor's responsibility paragraph why to avoid expectation gap. Mainly, we are expressing reasonable assurance. Reasonable mean less than 100%. We obtained sufficient appropriate audit evidence, mean not 100% work. We are not providing any guarantee. After that, there is a paragraph called other reporting responsibility. Sometime, according to country law, it is required auditor need to highlight this in the audit report as well. If there is any requirement according to country law, we will highlight where under other responsibility paragraph. If it is required by law, if nothing is required, this paragraph will not be there. And then auditor name, signature, and date. Auditor name, signature, address, and date. Whose name, signature? Engagement partner. Address mean address of firm. And a date the audit report is assigned. And this date should always be after the date of financial statements approval. Because on one day director approve financial statements, audit report is on financial statement. So audit report date should be after the date of financial statement. It should not be before the date of financial statement. Are you with me? So what are the contents of standard worded unmodified report? Title addressing, opinion paragraph, basis for opinion, key audit matter, other information, management responsibility, auditor's responsibility, other reporting requirement, auditor name, signature, address, and date. Now, there is something important. If we are expressing unqualified opinion, this opinion paragraph heading will be auditor's opinion, and this paragraph heading will be basis for opinion. If we are going to express qualified opinion, qualified report, this paragraph heading will be qualified report, and this heading will be basis for qualified report. If we are going to express adverse report, this heading will be adverse opinion, and this heading will be basis for adverse opinion. If we are going to express disclaimer report, this paragraph heading will be disclaimer opinion, and this paragraph heading will be basis for disclaimer of opinion. Are you with me? If we want to include emphasis of matter paragraph in the audit report, where it should be placed, it should always be placed between basis for opinion and key audit matter, mean before key audit matter. If we want to place other matter, not emphasis of matter, other matter will be placed after key audit matter. Anywhere, even you can put at the bottom. But if in our report we want to put both emphasis of matter and other matter, then both should come at the same place, either before, before CAM, either both after CAM. We cannot say, okay, emphasis matter we can put before CAM and other matter we can put after CAM. No, in case of both, they will come together. Either both before CAM or both after CAM. Only emphasis of matter before CAM. Only other matter after CAM. If we have qualified the report, the matter on which we have qualified the report, we have explained where? In basis or opinion. Obviously, that matter was a key from audit point of view. We don't need to repeat under CAM. What is emphasis of matter? Matter important from shareholder point of view. Correctly presented, disclosed in the financial statement. We are just highlighting. We are not explaining our audit approach. We are not contradicting with that matter. We are just highlighting. What is key audit matter? Matter important from audit point of view. Not shareholder, audit point of view. That we are highlighting in audit report along with audit approach. The difference between emphasis matter and key audit matter. Emphasis matter, matter important from shareholder point of view. Key audit matter, matter important from audit point of view. In emphasis matter, we only highlight the matter. We do not provide the audit approach. In CAM, we highlight the matter as well as we provide the audit approach as well. Emphasis of matter will come under modified report, while CAM is available in all types of report, either modified means standard verdict as well. And CAM is compulsory part of our report. It will come under unmodified report as well. While emphasis of matter will come when we want to modify the report. That's it for today. We are having class tomorrow. Yes, this week we are having 2 classes. Even lecture 1 in previous week we missed. That we will cover on coming Friday. Tomorrow we are having class. Next class will be next coming Friday and Saturday. We'll discuss that. Both can discuss, we can discuss. So tomorrow we are having class. The class time will be 2:30 to 5:30. Is that fine? Sunday. So that we can enjoy in the evening. So tomorrow class timing will be 2:30 to 5:30. See you tomorrow. We will practice some good questions on this audit report.